Good morning to everyone. I'm hoping you're all fine and, like always, ready to take a course of today. I welcome you all to yet another session of financial reporting. Today is a lecture number 6, effectively the lecture number 5, because the first session, the introduction one, was totally spent on introducing the course. Effectively, I've started off our course explanation from the second week and onwards. So effectively, today is the lecture number 5. We already have finished 5 reporting standards in the past 4 sessions. IAS 16 on property, plant and equipment, IAS 23 on borrowing cost, IAS 20 on government grants, IAS 40 on investment property, and IAS 38 was a recent topic in the last course we have done on intangible assets. Every time we finish a topic, we try to make sure that we finish it up by all of the aspects, the explanations, lecture notes, applications. And then when we are done with, we do objective test questions from exam kit. And after that, I always ask you to start putting your efforts within the course itself, not just in the month of November when it will be too late. I remember when we have left the course the last week, we have finished the IAS 38 intangible asset, but we could not find the time to practice few objective test questions from. So here we are starting the course by practicing few questions on intangible assets before we will be able to start the next chapter, chapter 7 on impairment of assets. So the board is all connected and we are starting ourselves with the question number 34, which is on research and development cost. And you'll be able to get an impression the way the questions of the exams are going to be like. So number 34, and that is on page number 13. See what amount will be charged to statement of profit and loss for the year ended 30th of September 8 in respect of research and the development cost. So they have asked us to answer the expense out effect that will be charged to profit loss for the research and development cost. The first thing that one has to notice is the year that we are in ends on 30th of September 2008. And if it ends on that mark, will be starting on 1st of October 2007. A company had 20 million of capitalized development cost at the cost being brought forward on 1st of October in respect of the products currently in production. So this project is currently in the phase of production. Research finished, development finished, currently is in the phase of production. In other words, this project is currently in the phase of sales. $20 million in regards to project 1. This project currently is in the phase of currently in production phase. $20 million, or I can write it in full length, $20 million. This has been capitalized as a brought down balance not the cost that they've incurred into this year. They say that it's being brought forward on 1st of October. So this has been the cost incurring it in all those past years, being capitalized in the past years, and the closing of last year's becoming the opening of this year. Moving on to the next. A new project began on same day. So I can mark this one as the second project. This one has just commenced. A research stage of the new project lasted until 31st of December 7. So if this project starts on 1st of October 2007, research lasts until 31st of December 2007. We can see clearly 3 months in it. And these 3 months are the months of research. What is the cost they have incurred during that time? They incurred $1.4 million, the cost. So the question of research and development is all about analyzing. Because it's easy to remember research to expense and the development to capitalize. But the actual thing is the way that it is tested into our questions that you have to watch, you have to sit and watch. And see, already in the space of 5 past minutes, I have done a lot of analysis. The very next day will be the day of development. And we have to see the day the development start till when it lasts. From that day, the project incurred a development cost of $800,000 per month. On 1st of April 8, the directors of a company become confident that the project would be successful and yield the profit well in excess of cost. The project was still in development at this date, and this is the date the year ends. So the development is continuing till the end of the year, which confirms that for about 9 months, the development is happening. Research for the first 3 months, development for the last 9 months. What is the cost they incur in those 9 months of development? Each month, 800,000. So for 9 odd months, the cost is going to be what? 800,000 multiplied by 9. 7,200 or 7.2 million is the cost that they have incurred in those 9 months, each month for 8. Yeah. When is the day the criteria is becoming satisfied? On 1st of April 8, the directors of a company has become confident of the project's success. Now, this confidence of success is the satisfaction of criteria. And that day is 1st of April 2008. So much of analysis. So how many months now we can see before then that? And how many months we see after to it? There are about 3 months before, and there are about 6 months after. So the cost of first 6 months will be, 3 months will be 2400,000, and the cost of the last 6 months will be 4800,000. What next? To capitalize the development cost needs to be amortized at the rate of 20% on a straight line basis. I did tell you the last week that the amortization is done by using only the straight line method. So they say that if any development cost you've capitalized, that will be amortized at 20% per annum using the straight line method. So first thing that needs to be looked upon is the research cost, because that is the first thing will count towards expensing. So I can highlight that in green color. This is the first thing that will be expense, research cost. The development cost is capitalized only once the criteria is satisfied, and this is the day the criteria is satisfied. So this cost will be capitalized this is going to be expensed. Okay. Now, the one that we have capitalized now will be amortized. The project is currently in the phase of development, production, and the amortization commences from the day the project gets into a phase of production, which is this project already in. So I will just come to multiply this by 20% to find me the effect of amortization. 20% of that figure will be 400,000. Is it or not? That should be the third thing. I have to highlight it in green color. This is how the way I have ended up getting that answer, 2 billion multiplied by 20%. Now, the one that we have capitalized, will it be amortized? No, the project 2 is still in the phase of development, and you cannot expect to amortize the development cost within the phase of development. So our job is pretty much done. I have to take 400,000 from here. 4 million, in fact, not 400,000, 4 million. It's 4 million. I have to take 4 million from here, 1,400 from here, and this. So 2,400 plus 1,400 will have to be 3,800. 3,800 plus 400 million will have to be 7.800. Just 1 minute. Okay. So this is the answer that will go into profit and loss. Our job is pretty much done. Which option do we have to select? Is the one that says this. That option is this one. Now, this question is difficult to handle by a student on the day of exam, and the clock is just running too fast. And especially when you in your life have never practiced these questions and you never got used to of, because it's on the screen, I'm working it for you. So you have been sitting it so relaxed and watching me with no such accountability or any sort of pressure, time pressure, exam pressure. Right now, you are sitting it into room, watching me working that question for you. So you may have been thinking of that. It's easy question. It's easy to solve, but it is not. I have been able to make this question look easy to you by the way that I'm making that analysis, dividing the whole thing into parts, taking the project 1 separately, project 2 separately, and then even within the project 2, research separate, development separate. Within the development, first 3 months, last 6 months separate, because everything has been so much being well explained that you may have started developing the feel that it was easy to handle. It is not. It is difficult question. And you do not practice these questions in your life, you definitely on the day of exam will struggle and will remember my words. It's the fifth financial reporting standard we are finishing. And if you already have not practiced any question on past 4 reporting standards we have done, then you can understand what you are doing to your course and what you are starting to doing for your course and what you have paid for and what you will get in return. You know yourself better. Look into yourself. So many times the past 4 or 5 sessions, I have tried to make you realize the importance of your own preparation, your own revision, your own practicing. And if you're still not wanting to listen to me for that, later, at least you will not be able to blame me for that if you fail the exam. It totally will be your fault. It totally will be because of your laziness. You're not willing to study, not willing to revise and practice and make your life a little disciplined in such a way that the studies can be a part of that. You never have been able to do it. So if you fail it, you will be the one to be blamed for. Technically, have you learned any new thing in this entire question? No. Amortizing the development cost is something that you know how to do it and why to do it. Research to expense, you know that. Now, technically speaking, the development cost to be capitalized after criteria satisfied, before it has to be expensed. Technically, you know every bit of it. But the way this question is set up is making the whole task difficult to apply that knowledge. And I'm doing that for you, so you may have found this thing to be so easygoing, but it is not actually. Fifth reporting standard we are finishing. Ask the question to yourself, how many times have you taken a courage to practice the questions from the exam kits that you have been provided? BPP exam kit has been provided. Kaplan exam kit you have been provided. Are you just happy to get this and not wanting to look into? What's the point of sharing it all to you on the first day when you are not even accessing it? Just being happy about that everything is there in the OneDrive. I have exam kit. I even have 2 exam kits. I have lecture notes. I have study text. Just I'm happy because of I have everything. Is this something to be happy at, or something to be happy at that you're using them off and practicing them off and completing it alongside? You are with the pace of the batch. 4 or 5 standards. I have done that for you. You at your side are also have done revising, practicing, and you're confident that I'm with the pace of this batch. And if you're not, you're doing bad to yourself. You were doing bad to yourself. Let's face ourselves and be honest. You already have started making the mess of this whole course. And sooner or later, you will face the music. And you will not be able to run away from, because ultimately one day you have to go into exam hall and sit in front of computer and attempt your exam. You will not be able to run away. Or else stop doing ACCA. Who's forcing you to do that? Is there any legal obligation? And a state has put onto you to be a qualified ACCA. Now you have to be. Don't do it. Who's forcing you to do that? But if you have to do it the way that it requires you to do. That's something that always I say to you. How many times I can practice these questions for you? Depending it upon the time, I have to balance everything. I have to run the course also, conduct courses for the new topics also. So everything has to be balanced, practicing the lecture note examples, then practicing some objective tests, and ultimately I have to move on to the next topic so that one day I can finish the course also. Or even if I have a lot of time and I can start completing everything for you from exam kit, what will you do on the day of exam? You never have developed the guts, the confidence, the comfort to see these unseen questions first and practice them and getting those answers done. You never have done those mistakes over the life and tried to refine. On the day of exam, all the mistakes you will do on the day of exam. Because you never have refined those mistakes by practicing questions over the life, and you were just living it into some fairy world, and your eyes will open on the day of exam. That is too tough to attempt. It's too time taking also. I've got only 3 hours. So I have a job to wake you up. And from the first day, I have already started doing it. Because if I start doing the same thing after 2 months, it will already be late. So I'll have to take you onto the right direction, if you're not already onto the right direction, in the first few sessions of the course. After 2 months, you probably will not see me saying this all to you, because that time is a time, it's already too late. Even you wish to get back into momentum, you will not be able to after 2-3 months. It's just the 5th, 6th session of this course. We are in the first month. So if I have to counsel you and make your direction right, it has to be this time. So listen to me. Choose to be a mentor of yours and listen to me for the guidelines, that for the reason why you have paid for this service and you later do not come to listen to me and whatever the guidelines, the precious guidelines that I share to you. What's the point of paying the price to get that service when the service is running, offering all sorts of helps, and you're not there to take those helps? This question is very difficult. All because of the reason of its analysis, that the way it needs to be sit back and relax in a very comfortable environment. You will have to see, okay, the project one, the cost of that one is this. And they said that the project is in the phase of production. It has a message into it. They are signaling towards that. If they're telling us that this project is in the production phase, they're hinting towards amortizing it. Otherwise, $20 million they have capitalized. I did not capitalize this. They already have capitalized this. So I'm not there to make a choice to capitalize or expense. This thing, if they had said, they hinted me towards amortizing it later on, which I did. Then for second project, they say that they start not just today. So project starts off with the research. So the research starts the same day the year starts. Till when it goes by? Till this date. So I noticed that, okay, 3 months of research, this is the cost of research. The very next day, the development starts. Till when it goes by? Till the end of the year. That means 9 months of research, the cost is this. Which day is the day they're becoming satisfaction of criteria? That day was this. So how many months before, how many months after? And because the question wants me to answer the expense of effect, so I've started taking those figures. Research to be expensed. Criteria when was not satisfied, development cost to be expensed. Then another thing that I have to expense is the amortization. This cannot be amortized since the project is still in the phase of development. This for surely I did and got me my answer. So even after understanding, technically, you've become a knowledgeable person. As you're in the safe hands, I'm doing my best to just throw all of my expertise towards you to make that topic easy. Imagine everything is so fine. You have become so fine with the question that I have worked, the topic that I have explained. But point is that if this thing, you will not do it at your side and will just be assuming that I have understood the whole topic. And I've seen the way the lecturer was practicing the questions. I found those questions to be easier. This is not done. You have to practice some questions by your side to experience the taste, the flavor of unseen questions. Many times you will do a mistake. You will take more time to solve those questions. With practice, you will refine those mistakes. You will manage the time better than you have started practicing. So you probably were taking 5 minutes to answer one question. You have to cut down that to 2 minutes. When will you do that? A night before the day of exam? A week before the day of exam? These days, when we are living a normal life, no exam pressure, no additional classes, just once a week we meet, take one topic and we learn, and then 6 days we relax. Can't we give any of the day in those 6 days to revise and practice the question? Ask the question to ourselves. We will feel bad about ourselves if we are not practicing any questions and not listening to the lecturer's instructions. At the back of our mind, you will feel bad about it. Another question of the same kind requires us to do the same thing, and we can do that before we move to chapter 7. This one is on IS 38. This question requires more or less the same thing. They say that what is the carrying amount of intangible assets to be recognized in respect of the project? That is, what is the total amount of the company that will charge to profit and loss? Two things they have asked. One thing, the expense or defect. The second thing is that the carrying amount of intangible asset. This is the year of concern. That's the first thing that I have noticed. Question number 37, and it is on page number, which page is it? 14. The year that ends on is September 2005. So if it ends on September 2005, it must be starting on 1st of October 2004. D company's year end is September 5. Fine. D companies commence the development stage of the project to produce a new pharmaceutical drug on the 1st of Jan 5. So there is no research, as they have jumped directly is into a phase of development. The day of starting to develop is 1st of Jan 2005. That is the date I have been able to notice. 1st of Jan 2005, the development kicks off. Next, expenditure was 40,000 a month. Project is going to be completed on June 5. So let's go to right. The day the development completes, that day is 30th of June 2005. So the development starts within the same year and completes within the same year. Based on to that, I can count the months of development. See, the moment the question starts, I've started making all of this analysis. Very important. Making the analysis, the day the year starts, the day the year ends, the day they start to develop, the day they end to develop, the day the research starts and ends. Right now, there is no research. Cost incurred in each month, the day of criteria being satisfied when. This topic is all about that. 6 months of development. Let's see which day they're going to satisfy criteria. The directors, they became confident of the project success on the 1st of March 2005. Now, this is the day the criteria is getting satisfied. That day is somewhere in between the two. Criteria satisfied. So how many months we see before criteria? How many we see after? I can see 2 months before, I guess. Yeah. And I can see 4 months, the balancing after to it. So the first 2 months will be expense. This will be capitalized, which then can be amortized. The cost in the each month is 40,000. That means the cost up there will be $40,000. Sorry, $80,000. As for each month, it's 40,000. So it will be for 2 months, 80,000. For 4 months, it will be 160,000. This is definitely going to be capitalized. This is going to be expensed. Okay, the one that we have capitalized, will it be amortized? Can have a chance because the development is completed. So can happen the very next day they get into a phase of development, but we will never have to assume. We will have to look into it. What do they say? Yes. The very next day, the commercial production starts. They say that the drug went into a commercial production. So the commercial production starts the very next day. Another thing that needs to be written is this. That is the day the production starts the very next day. So till when? So how many months of production applicable to our year? That's gonna be for how many months of production? That's gonna be for 3 months. So I have a chance of amortizing 3 months of the development cost. As I can see, since the day the production starts, the year ends on September. All about analysis. All about analysis. Months of research, months of development, months of criteria, months of production, starting the year when, ending the year when. Technique remains to be the same. Facts and figures in the question only has changed. This is what you have to copy, and you have joined the course of FR with me to copy me the way I answer those questions. And if you do not know what you want from this course, if you're not copying the way that I'm answering these questions, not exactly the answer needs to be copied. The way that I'm adapting to answer this question needs to be copied. This question cannot be done on fingertips casually. It requires to be done on paper. The question was requiring us to answer the charge to profit and loss. So this is the first thing that will be charged to profit and loss. I have been able to highlight it in Greek color. The amortization, let's go to find. What we have capitalized will be amortized. So 160,000 is capitalized. The life of the project is about 5 years. I need to amortize it for 3 odd months applicable to this year. So the answer of that will be what? 160,000 divided by 5. It has to be 160,000 divided by 5 multiplied by 3 divided by 12. It's about 8,000. Now, this is another thing that will be expensed. So what will be expense to profit and loss is 88,000. So let's see if I can see it somewhere else or not. Yeah, it's there. So that is the first thing I have to click on. That is going to be charged to profit and loss. And then what will be the carrying amount? So this is the amount that we have capitalized. See, 120,000 is what, so 160,000 is what we have capitalized. So if I go to expense this amortization effect out, what's getting into a statement of financial position for the development cost after amortizing, it should be this amount. So here we are and got this and end the whole story. This how the way the questions of the development and research cost are going to be like. They're not as easy as they give you an impression, because I have been able to make those easy for you. It's only that impression you develop that it's easy because I'm doing it for you. You're just sitting there and watching me do. It's not easy. It's time taking, even if it is technically fine and you can do it, but you will take probably 7 to 8 minutes to solve this question, which you do not on the day of exam have to have that much of a time to solve. The questions can even be like that. Which of the following would disallow the capitalization of the cost? Means which of the condition is not the criteria? Means 3 of them they will allow, the one will not. So we'll have to find that one odd one out. Development of the project is not yet complete. No, so you still capitalize the cost of development even if the development is going on. So it's not that we do not capitalize the cost of development just because the development is not finished yet, but we keep on capitalizing the cost of development within the phase of development also. So this is not the good option to select. They say that the development cost, development of the product is not yet completed. So this cannot disallow the capitalization of development cost. We still capitalize the development cost even within the phase of development. No patent has yet been registered in respect of project. Same, the patent does not need to be registered to capitalize the cost of development. The development is going on and you capitalize it as long as the criteria is satisfied. The criteria, you know, sector ACCA. No sales contract have yet been signed in relation to project. Now, within the sales phase, development phase, we never have talked anything like that, that the contracts needs to be signed for the development cost to capitalize. Patents needs to be registered for the development cost to be capitalized. Development needs to be completed for the development cost to be capitalized. Even when that all is not happening, the development cost is still capitalized. Once the criteria is satisfied, and you know the criteria is something else, SETCTOR, it has not been possible to reliably allocate the cost. Yeah, this can only be the reason why the development cost is not capitalized, because if you cannot estimate the cost, what can you expect to capitalize? You capitalize a cost which you're not estimating it reliably. So that can become the reason of why the capitalization of the development cost cannot be achieved. So I will select. Remember, one of the criteria clause was sector, SECTOR. E stands for expenditure identifiable, which is not satisfied. So if expenditure is not identified, expenditure means cost and all. If that one is not reliably estimated, reliably measured, this can stop the development cost to capitalize the one that I have selected. The questions can even be like that. So enough of a time I have spent on, and after this now we are taking ourselves down to chapter 7, which is the topic of the course of today, and a topic for which we have waited a lot. Yes, long way back, 5 sessions ago, 4 sessions ago, when first time these models of valuations came to our way, People have seen something like this impairment. And since then, we had been like, look, we will do that in chapter 7, in IS 36. And that time today has come. So it's a long awaited topic. It's a long awaited. We've been waiting it for long to explore it. And today, finally, the time has come that we go to look in what it is. So it's one of the component of cost model. It's one of the component of valuation model. That means after completing the topic of impairment, the models of valuations will even be completed. And how cannot this happen that we will be studying impairment topic today and this depreciation thing will not come back to our way? The cost calculation will not come back to our way. Valuation, because it's the same topic. Impairment loss is a part of these models of valuation. So where you will be working on impairment, the same question will require you to work on to depreciations, revaluation, because all of these things are interconnected. So having a knowledge of everything you have done so far, cost model, valuation model, how to value, accounting for valuation, disposals of assets, depreciation, straight line, reducing balance method, policies must have to be with you. Everything will come back to our way today because impairment is a part of these models of valuation. So when you will talk about the impairment, these models of valuation will equally be applied to our course explanation. Everything is connected and you must have to prepare all to expect to do good onto the day of exam. So let me close this and focus only on impairment of asset. Let me try and give you the first of all, a basic scope of this topic, what this impairment of asset is about. Let me open its board book, chapter 7, IAS 36 on impairment of the first of all, this asset is this thing is applicable to both the tangibles and intangibles. And that's the reason why we're learning it out after completing both the types of assets, the tangible ones and intangibles. I do not know why this file is malfunctioning a little. Tangibles or intangibles. Means this is applicable to IAS 16 and IAS 38 both. May the assets are tangible ones or intangible, it will be applicable to both. See, this is the carrying amount of an asset, randomly $500. Carrying amount is the amount at which the asset in the books being carried at. And here comes the recoverable amount. Now this term recoverable amount, you probably have seen me calling it first time in the course of financial reporting, which is 300. What is recoverable amount? Don't confuse this with the revalued amount. That's something else. It also starts from R, revalued amount, but revalued amount is something else. Recoverable amount is something else. Recoverable amount, as the name suggests, recoverable. It is the amount that can be recovered by the use of asset, or the amount that the asset can recover back to you. Or in other words, the value of an asset is called as the asset's recoverable amount. I can come to expand this explanation in a while, that how to calculate the recoverable amount in detail. But roughly, the idea is that the asset should not be carried in the books at the value more than to what we expect to recover from. The asset should not be carrying in the books for a value more than to what we expect to recover from. This is the amount that we expect to recover. Should have not been kept. Means this has been the true value of an asset. And I should not be keeping my value of an asset at the amount more than to what it's worth. So I will have to write it down to 300. This write down effect is called as impairment of an asset. And the difference that we have found is called as impairment loss. Or in other words, you can say that the fall in the value of asset is called as impairment loss. Or the amount by which the carrying amount exceeds over to a recoverable amount. That excess is called as impairment loss. So by how far the 500 exceeds over to 300, 200, that excess is called as impairment loss. So in the background, the objective should not be overlooked. The objective is that the asset should not be carried at the amount more than to what we expect to recover from. This is what we can expect to recover. And we should not be keeping the value of an asset at the amount more than to what we expect to recover from. It will be a problem. Yeah. If your asset is suppose carried for 100, this case leads up to say no impairment, because we are keeping the value of an asset well below, well within the range. Means this 100 will easily be recovered, so no need to impair. It's not like valuation surplus. Now you will go and take the value of an asset up to 300. Impairment loss is just one dimension. It's just a fall, write down effect. If the value is already less, fine, objective is satisfied, nothing to be done. But in case if it has been kept more than to what we expect to recover it from, then in that case, the asset needs to impair down to 300. That write down effect is called as impairment loss. So an asset should not be carried at the amount less than to what we are expecting to recover from. Carrying amount is the amount at which currently the asset in the books being carried at, recorded at, presented at 500. And this is the true value of an asset. So looks an unfair to overstate an asset which you cannot expect to recover from. So bring it back to its original value. To bring it back, that write down effect is called as impairment loss. This is the basic theme of this entire topic of impairment, that you should not be keeping or carrying your asset at the value more than to what you can expect to recover, or it pays back to you 300, and you are keeping it at an artificial amount which it does not pay you back even. So have to bring it down to its original value, true value. That write down effect is called as impairment loss. Check this out. Impairment loss is the amount by which the carrying amount exceeds over to a recoverable amount. So carrying amount was 500. Recoverable amount was 300. And this is by how far the excess has been found, which is called as the loss of impairment. Carrying amount is the amount at which the asset in the books being carried at, recorded at. While recoverable amount is the amount that can be obtained either by using an asset or by selling an asset. This discussion, I can expand it in a while to words. Objective is what? Asset should not be placed in the statement of financial position at a value no more than to its recoverable amount. That's that objective. To meet it up, we bring that 500 down to 300. That effect is called as impairment loss. There are two possible ways we can expect to recover the value of an asset from? Listen, are you ready to? See, assets are held for use, undoubtedly. So that's the way we recover the value, by using an asset. If laptop, I have it into my business, I have been using it from the past, say 10 years. Let's be realistic, 2 years. And I will be using it even the next 2 to 3 years. So this recover is paying me back. This laptop is paying me back over the life by using it. So an asset is held for use and recovers its value by using it, not selling it. But that option to sell exists always. I can just sell this laptop to someone today and get all the money back. I don't do it. I don't intend to do it. But that option to recover the value always exists. Are you getting my point? You have a car. You have purchased the car with the aim of using it, driving it. You probably have driven it the past 2 3 years, and you still want to drive that for the next 3 to 4 years for your family. That's what the intent behind in buying a car. And that's the way you expect to recover the value of it. But the same car, you can sell it today in the market to recover all the value, which you do not intend to. But that option to recover the value does always exist. That's the reason why the recoverable amount of the asset is not just the use value of an asset. It can even be the sale value. Selection in the end is based upon by picking the higher of two. Whichever is the higher one is going to be the asset's recoverable amount. So with the time coming forward, I will be able to explain to all of you in detail how to find the sale value of an asset. So I will come to explain to all of you in detail the sale value of an asset, the use value of an asset, how to find the sale value, how to find the use value. But basic thing is that there are two possible ways you can expect to recover the value of the asset from, is by selling an asset or by using it. The higher of two has to be the asset's recoverable amount. Once found, I will see by how far the value of an asset is being kept in the books more than to what we are expecting to recover from. If that has been the case, we will bring that value down to its assets recoverable amount. That write-down effect is called as impairment loss. Okay with that? So before we take ourselves down to the detailed explanation of how to test an asset for impairment, we will have to first get ourselves done with when to apply the test of impairment. When to. By the way, what does that mean, test? It is also called as impairment review. Why do we say this as impairment test? What's the whole point behind in calling it as test of impairment? See, we are trying to put this asset on a test. If it is impaired or not impaired, it's like a trial. It's like a testing. After you may have determined the asset is not impaired, because you're checking that if the carrying amount is more than 2 or less than 2. So to check this, it's called as testing an asset for impairment. After you may have conducted the test and the outcome is that it's not impaired or it's impaired. You only get to know that after testing. So that's what this word test over here means, that you are checking it out. If it is impaired or not, this thing is called as reviewing an asset for impairment or testing an asset for impairment. So when to test? There can be some internal factors or external factors. Now, these factors are the factors where you will have to wait for these factors to come. As impairment law review is not like a depreciation thing that every 1 year it has to be performed. It will only be performed whenever we have got those factors. Factors, you can say these are some conditions. not I would say conditions even. These are some clues. They will give us a clue that our asset might have been impaired. That asset might have been impaired. That asset might have been impaired. Or you can say that these are the issues, problems. The problems can be inside of the business. The problems can be in the outside environment. So internal factors are those are the issues within the organization. Outer factors are those are in the external environment. So impairment review is performed only when we have got these sorts of issues. It's not like the valuation or a depreciation thing that every year it has to recur. It's not annual. It's only to be done when we have got those factors. Internal factors, physical damage to an asset. You can understand why this factor is an internal one. Physical damage to an asset. Why this factor is an internal factor to us. An asset gets damaged physically. Taking an example of anything, laptop itself, I hope it will not be damaged because I have to run my courses. My business is totally set up onto this one piece of machine. Although there are a lot of machines, but laptop is considered to be the most important thing to run my live online courses. If it gets damaged, will I be able to use it? No, I will not be able to conduct any course because it's damaged. It's not powered on. Does have some operating system issues, does have got some, I would say, camera issues or any issues. I cannot use it to run the courses. It means by using, I cannot recover the value of it now since it's useless. The value of that is zero, or if not zero, close to zero. Second option was to sell it. Will I be able to sell it? Who will buy a laptop which does not function anymore? Or may I have to scrap it? So scrap value is a very small value. It means the sale value has gone down, the use value has gone down, overall the recoverable value has gone down, and chances are there this laptop will be impaired. Because in the books, this laptop has been carried, say, for $500. But the recoverable amount of this laptop is almost close to zero now. Since I cannot use it, I cannot sell it. Big impairment loss is expecting to be there on laptop, as the book value of this laptop today is $500, even after amount depreciating and all. But the recoverable amount of that almost have gone down to zeros because of its physical damage. So you can understand how an impairment loss will come in when there are some issues going on within the business, like physical damage to an asset, operating losses, loss of key employees, management reorganization. So there's a lot of mess up inside that leads my assets to be impaired. External factors like technological obsolescence. The technology changes rapidly. You know that you're living into that era where the technology has become so fast that every second time you see a new model of, if I take an example of your cell phone that you carry into your hand, how rapidly the new model of that cell phone comes in, how rapidly. And if the new model of that cell phone comes in, the value of the previous model goes down. Not because physically it has got some issues, technologically. It's not as advanced as the new model is now. It can do a lot of things that the previous model cannot. So based on to that, the value of that has gone down. So as a result of technological obsolescence, the value of an asset may have fallen down, but the carrying amount of that has not, because in the book value is still kept keeping it at its carrying amount, whatever the amount that was being kept at after depreciating and all. So physical damage and technological obsolescence, they will lead to same issue. Physical damage is internal issue. Technological obsolescence is external problem. Major adverse in change in economic environment in which an entity operates. Recession. Adverse change in economic environment is a recession. COVID. Can you remember that year of COVID, the confinements and all, how many of those businesses being disrupted, closures, losses. Adverse change in economic environment is an external problem. Major decline in a market value of an asset. The market value of an asset has gone down because of some other reasons. So all of these things, they have this sense of market issues. Technological issue is a market issue. Or there might have been a change in regulations. Because of those regulations, the asset cannot be used. So now the value of your asset is zero. Since you cannot use it, you cannot sell it, because no one will buy an item that's no longer in use, that's not been allowed by a government to be in a use. So regulatory change is external problem. Technological change is external problem. Market value has gone down, external issue. COVID, recession, external issue. Internal issues are what? Staff leaving the company. Operating losses, operating issues are there. Physical damage to an asset. So these factors you do not have to cram. These factors are given there to make you feel comfortable about. By sensing it, that yeah, these are external factors, I can sense it. These are internal, I can sense it because of its nature. So practically speaking, when an impairment review has to be performed, these factors are looked for. Else, impairment review is never performed. Impairment review, I'm telling you, it's not like a depreciation or a valuation thing that's annually. Each year one has to test. It will only be when you will find either of these situations. Situations can either be the internal ones or the external ones. And these are testable in exams itself. The questions can be like, which two of those factors are internal? And you are provided with the 4 options within which there are 2 external factors, within which there are 2 internal, and you have to select the 2 of them. Those are external or internal. Exactly that way, the objective test questions are even tested. And that's the reason why I'm spending time onto it, not letting you to just read it. See, if anything, that has become a part of the summary. That gives you this bit of a feel that it's important. If that was not important, I would have not shared this being the part of this summary document. It's that important, so it has become a part of this summary. Because this is itself going to be tested. So over and above to your understanding that the impairment review is only performed when we have got these sorts of issues going on. Other than that, it itself in exam will be tested this way. How often to apply the test of impairment? And this is the answer which I have explained it to you, that you have to apply the test when the factors do exist. When the factors do exist. Just 1 minute. So as I was talking about, when the factors do exist, then we only can test an asset for impairment, else we cannot. But there are few assets, exceptionally, those are tested for impairment on annual grounds. And the list of that includes the goodwill, the one that's being purchased, intangible assets, the one that we've talked about the last week. Those they have infinite life, and those are not yet ready for use. And the goodwill, the one that has been purchased. So what I can do, I can take you back to that summary, and I can take that same moment to show. See, when we were discussing the goodwill the last week, this thing was written. Tested for impairment annually. Even the intangible assets, those they have infinite life, they are tested for impairment annually. But those they have a finite life, they are only testable when the conditions do exist. So I was not explaining that to you at that time, and now I can cross-refer it. That those intangible assets, those they do have infinite life, they are tested for asset impairment annually. And the goodwill, the one that's being purchased, even tested for impairment annually. That now you also can see today, being the part of that summary is written that some assets are tested out for impairment annually. That includes goodwill, the one that's being purchased, intangible assets, the one they have an infinite life. So a lot of information on this page requires you to spend time on before we actually take ourselves down to that computation stuff and how to test an asset for impairment. You must have to respect it. So before I take you on to the next page, let's go and take a quick recap of what this topic is about. It says you should not be carrying your asset at the value more than to what you're expecting to recover from. If that has been the case, bring it down. That write-down effect is called as impairment. If an asset is already being kept at the value less than to it, no need to do anything. There are two possible ways we can expect to recover the value of an asset from: by selling it, by using it. Higher of two has to be the asset's recoverable amount. Internally and externally, we will have to wait for some factors to come before we test them out for impairment. External factors could include technological change, regulatory change, adverse change in economic environment, decline in the market value of an asset. Internal factors will take physical damage to an asset, staff leaving the company. There are lots of operational issues inside, losses inside, cash flow issues inside. All the assets, they are tested for impairment when they have those factors. Else, they are never tested. But there are few, those even are tested annually. Those include these three of them: the goodwill, the one that's been purchased, and an intangible assets, those they have an infinite life. And finally, how to test an asset for impairment. If today you can listen to some sort of distortion in my mic, it's because of somewhere there's a work going on. Because I sit into my commercial workspace. I've taken a workspace in commercial building. So you never know when there's some work going on the office on the left-hand side, maybe on the upper story or maybe on the lower story. So I do not know my mic is catching it up, this voice or not, and you get the chance to listen to it. But at least because I'm feeling it, that there's some work going on. So I can sorry for that if you are also being disturbed with this sort of work. I cannot help it. It's something that someone's work, and if they're doing it, I cannot ask them to not to do it because I'm working. It's not my home that I can ask my family to be a little organized when I'm taking a course. So sometimes we have to bear it. But I hope it's not disturbing you as it's disturbing me, as Mike is not catching it up a lot. But even if you are still listening to it a little bit, I hope it's not disturbing it a lot. If I can ask you, any one of you, to give me a little feedback, if this might confirm me if it is disturbing or not. Yeah. Okay, thank you. Yeah, because the mic usually senses the voice of an individual or human. Yeah. most of the mics, they have this sort of, yeah, thanks for confirming. So it means I should remain confident that you're getting the best quality out of this course, my voice, my video. Okay, thanks for confirming. Fine. Yeah, the mic actually, when you have a good quality mic or even an ordinary mic, it usually senses the voice of a human, unless or until it is too loud that someone is using a hammer directly in front of mic, then you probably will be able to listen to it. But otherwise, the voices those are around the mic usually does not capture it. It usually captures the voice of a human. Anyways, good for all of you. I'm confident now that you're getting a good quality of audio and video from my side. How to apply a test of impairment? This will take us back to the start of the topic, that we must have to check by how far the carrying amount of an asset exceeds over to a recoverable amount. That access is called as impairment. See, the carrying amount was 500 according to my assumption. Recoverable amount was 300. And the loss of impairment that was found in it was 200. So there's nothing new in it. But what we are here to learn for the very first time is the detailed explanation of recoverable amount. The recoverable amount is the higher of two things: the sale value of an asset and the use value. Higher of two. It's also called as fair value less cost to sell, or NSP, net sale price, net selling price. So it takes the fair value, which means the proceeds of disposal, and cost to sell, which means any sort of cost that they expect to incur while selling, like advertisement is a genuine selling expense, offering the discounts, lowering the price by offering the discount is a cost to a seller. Agency fees, hiring an agent who has to help you in selling your asset on your behalf. So agency commission, surveyor fee, valuation fee, auctioneer fee. All of these examples are the examples of selling cost. These need to offset it against the proceeds to find the value of fair value less cost to sell. As the name suggests, fair value less cost to sell. In contrast to that, the value in use is the term we have to use it for the use value of an asset. You see, you need to be organized in remembering these terminologies the way they are called as. Value in use. Remember it. Use value is just a casual word, but formal is value in use. Formal is fair value less cost to sell. But broadly speaking, you can say that the sale value of an asset, use value of an asset. So how to find it? When an asset recovers its value by using, it does not recover in value overnight. See, I was giving you an example of this laptop. If this laptop is recovering its value, I've been using it from the past 2 years, and I will use it the next 3 to 4 years. So the laptop will recover its value by using it over the life, not just overnight. So the reason why there we have to discount the cash flows, because many of those cash flows I expect to get in the future years. So I must have to find the present values of it. So this discounting the cash flow thing, you people have done that in your financial management courses previously, in management accounting courses. A little bit of that in this course, we will be able to do that. Or if so far you have not seen that present value calculation somewhere else at any stage, I will be able to explain to you. But because those cash flows, they expect to come to our way in future, we must have to find the present value of such. And these cash flows will include one more thing, including scrap value. Because even after you're using, but after use, at the end of its useful life, you will be able to throw it away. That value on the day is called the scrap value of an asset. So scrap value is going to be the last one cash flow that you have. See, this laptop, after 5 years of use, I expect I will be able to sell this off for whatever the price. That is the scrap value of this laptop. So over the life, I will recover the value of this laptop by using. And then in the end, with that scrap value is going to be another cash flow to me. The scrap value is going to be another cash flow, which will be topped up while discounting those cash flows to arrive at value in use. So both of these figures, we have questions to how to find them up, we will do. That is the recoverable amount. So recoverable amount of an asset is the amount that you can expect to recover it either by using an asset or by selling an asset. Fair value less cost to sell takes proceeds minus all those sorts of selling cost. Value in use, the value that you expect to recover by using over the life, and you must have to find the present value of such future cash flows, including the scrap value. Just give me one minute. Okay, sorry, it was an emergency call, so I had to take it. So where we were. So we were having an idea of how one should have to test an asset for impairment. In detail, we have had a good talk in regards to what is a recoverable amount, the higher of two, the sale value of an asset, the use value of an asset. Sale value of an asset is called as fair value less cost to sell, which is fair value, say disposal proceeds, and cost to sell takes all sorts of costs, which on the day of sale, the business expects to incur in shape of advertisements, discounts, agency commission, auctioneer fees, survey fees, valuation fees, could be a transportation cost. While value in use is the discounted cash flow effect. For all those cash flows, the asset expects to generate over the life, the present value of that is called as value in use. That includes also the scrap value, which they expect to get at the end of the asset's useful life. We have one question on which we can apply this to start computing it a little. And that application is this one, learning example 7.2. What impairment loss, if any, the Odeon should record in the year ending 30th of September 2008. Odeon operates in a market which is suffering from downturn in economy. In accordance with IS 36, it is therefore undertaking the impairment testing of number of assets. See, downturn in economy is external problem. So may there has been an external issue, or may there has been an internal factor. Problem, the point is that they have found a factor, they have found a clue, they have found an issue which will give them a push to go and check their assets for impairment. After checking, they might come to the conclusion their assets are not impaired or their assets are impaired, but only after checking they will be able to. That is what we call it as checking an asset for impairment, reviewing an asset for impairment, testing an asset for impairment. So randomly, I can take any asset. Asset 3 I can take to look in. That's learning example 7.2, I guess. So I can write it by taking the two things. The one is the assets carrying amount. The second thing is the assets recoverable amount. Well, the recoverable amount is going to be the higher of two things. The fair value less cost to sell, or I can write that as net selling price. This can be written as value in use. So net selling price, fair value less cost to sell, it's 18500. 20,000 minus 1,500, 18500. While the value in use is given as 17900. While the carrying amount of that is also been given 18600. Selection is based upon by picking the highest of two, which is this one. So once the recoverable amount has been found, now I can see if the loss of impairment does not exist. By how far the assets carrying amount is in excess over 2 by 100. So that should be the figure of the loss of impairment. This is what needs to be done. In this question, the impairment loss has turned out to be 100, while the impaired value, which means the value of an asset after impairment, will now be 18500. This is the value of an asset after impairment, which is called as impaired value of an asset. This, how simple is it? This, I have done that for asset number 3. Now I can repeat the same story for one more asset, and then you can do the same for the remaining two of them. If you adopt this way of solving, the life of yours will become very easier. And way means you start from the bottom and goes to the top, as you have to find the recoverable amount in the first place, and then later you come to check this out by the carrying amount of an asset to see if it is more than to that or not. So it's a bottom up approach. I can take asset number one into my next just to see. Let me rub off those figures so that I can put the new ones. For asset one, the carrying amount is 230,000. While the recoverable amount is fair value less cost to sell, that's going to be 229500. 240,000 minus 10500, while the value in use is given is 235000. Selection is based upon by picking the highest. We have picked. Now I can see the value of an asset is being kept already within the range. So I don't think the loss of impairment does exist. Because here we already are satisfying the objective. What is the objective? That you should not be carrying your asset at a value more than to what you're expecting to recover from. So you are already keeping the value less than to it, well within it, means you are already satisfying the objective. So impairment loss will be zero and impaired value of an asset will be the same as original 230,000. So after reviewing, you get to know your asset is impaired or not impaired. This how the way you can complete this application by attempting the other two assets. Because of this external factor, they have given me a push to go and review. And I have reviewed. I found the asset third is impaired, asset one is not. And see the way back into lecture notes, the things are written. Impairment loss is where when the carrying amount is greater than the asset's recoverable amount. Well, the recoverable amount is the higher of two things, fair value as cost to sell and the value in use. If you look back into it, they're defining it was is the asset's recoverable amount. The recoverable amount is the higher of fair value as cost to sell and value in use. See, internal factors, evidence of obsolescence or damage to an asset. Current period losses or cash flow issues they have. Management reorganizations, loss of employees. External factors take decline in market value, adverse change in economy, technological obsolescence, indications of impairment, factors of impairment. See, for all the assets, indications of impairment lead us to a review. But annually, there are few of them. See, summaries are made out of it and makes the task more easier, more friendlier. But after that, I always have done this habit of showing to you the lecture notes onto a screen just to gain your confidence that the same thing has been done back into your lecture notes. And you should develop this habit of reading it. Develop this habit of reading the study text, your lecture notes. It will help you a lot with all those future exams to come to you, especially at level 3. So impairment loss is defined by the amount, the carrying amount of an asset exceeds over to the recoverable amount. Good with that. No problem. Got it fine. So far, so good. We'll take a break for 10 minutes. Upon the resumption of the course, we will have lots of things to talk about, like we will go into the accounting of impairment, and quite many stuff is expecting to come to our way in the second half of the course. So stay tuned. Do not go anywhere. I will see you in about 10 minutes to continue the course. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. After getting to know the way the impairment review has to be performed, we are taking a leap towards the accounting for impairment, what to debit, what to credit, how to present, where to present. The learning example 7.3, we will have to solve, which is slightly more difficult than the one we have done. To perform an accounting, one has to have the figures. So we will be using the figures of this question to perform an accounting on the basis of. So first, we will come to revise the whole of the process of impairment review in this question. And once we are done, and we will be able to also talk about the debit and the credit effects. So Warner has identified the following assets being impaired. There are two of them. They want us to prepare the extracts from the Warner statement of financial position at 31st of December 8 and the statement of profit and loss and other comprehensive income for the year ended 31st of December 8. This is learning example 7.3 and a property which cost 400,000 was revalued to 600,000 on 31st of December 2006 after a 5-year of ownership. So they're valuing. So we know how to value an asset. See, before starting the topic, I was telling you this depreciation thing, the valuation thing will be a part of our questions today because impairment is one of the component of those models of valuation. So it cannot be possible that you get a question of impairment and you're not tested on depreciations and valuations alongside. Definitely are tested together. So they have valued an asset in the first place back in 2006 after a 5-year of ownership. At 31st of December, the recoverable value of an asset is calculated to be about 550,000. The useful life of the property was estimating to be about 50 years on that date of purchase. This has not been revised. So this is the day they are reviewing it for impairment. This is the day they are valuing an asset. So what comes first, we will deal it with first. 31st of December 2006, standing it on, they are going to value. They're going to value. Now, this is the day standing it on, they're preparing the financial statements. And that is standing it on, they're valuing. So the two of those things to be worked, the carrying amount and the assets revalued amount. In fact, the revalued amount is given to us. So the carrying amount needs to be found. Cost is 400,000, valued to 600,000 after a 5-year of ownership. Means after 5 years of expired life, this is all what is happening. So let's go to find the carrying amount, standing it onto that day. 400,000 divided by a life of 50. 50 years. Multiplied by the 5 years of expired life minus 400,000. So 400,000 divided by 50. Multiplied by 5 minus 400,000, the figure has to be 360,000. Well, the revalued amount they've given to us is 600,000. So that takes the value of an asset up to this. The valuation gain of 240,000 that we have found will be recognized in OCI. You should not be forgetting from the topics of valuations previously. So we are done with valuation. Is this the way we value an asset always? We work the carrying amount of an asset, we compare it to its revalued amount to see the gain and the loss that we have found. That is a gain of valuation, which will go in OCI. Sorry. And then the day that they're coming to test this asset out for impairment, once again, we will have to try and find those two things, the carrying amount in the first place, while the recoverable amount they've given to us. So we do not really need to work hard for that. Recoverable amount. What is the, have they provided for the assets recoverable amount? It's given as 550,000. Well, after revaluation, the depreciation is based upon the revalued amount and remaining life. Is it or not? So the revalued amount is 600,000. Because after valuing an asset, the value of an asset in the books now has become this. 50 years in the total, 5 years till valuation got expired. So standing it onto that date, the remaining life was 45 years. That should be the life I will have to continue with. How many of those years further being passed by? That is 2006, that is 2008. 2 years have gone by. So the answer that is turning up to be what? 600,000 divided by 45 multiplied by 2 minus 600,000. The figure turns up to be 573,333. So by how far the assets carrying amount is more than to its recoverable amount, that access is called as impairment. This is the loss of impairment. We have ended up working it out. On the basis of that, I will come to explain to all of you the accounting, what to debit, what to credit. Good going. So computation wise, at least you have to be so much pro at. You cannot expect to make a trouble on working the carrying amounts, because the real thing in this question is to work this thing. Recoverable amount is provided to us. Revalued amount is provided to us. What your task is to get this figure done by making the use of the right straight line method of depreciation, reducing balance method of depreciation, using the right facts 5 years out of 50. And then after evaluation, this should be the 45 and 2 years of further jump, because this is 2006 back in and this is 2008. So 2 years were further expired. If you're unable to get this amount right, this will even not be right. You know what I'm talking about. So the real hardship is to get this figure done all right. Let's do the part B of this question, and then we can deal with the accounting thing in a one go. Second one is machine. And this machine is being valued or not. Machine with the cost of this much on that day had a recoverable value of this much. The machine was being depreciated over the life of 10 years. Yeah. So this was the property. And the second one is the machine. The cost is given as 100,000. No, in fact, I'll start it off the same way. This December 8, 2000. Two of those values to be found, the carrying amount and the assets recoverable amount. The recoverable amount is given as $70,000. While the carrying amount we have to work, the cost is given as 100,000. The life is given as 10 years. How many of those years have been expired? This is the day back in 2007. The asset was purchased. That is the day it has been disposed. How many of those years have gone by? It's by 2007, the half of the year 2008, 1.5 years have gone by. So 100,000 has been the cost. The life is 10, 1.5 years being expired minus 100,000. See, once again, I will show to all of you this computation thing. And sitting it from that place, it looks simple. You as a student on the day of exam struggles onto this thing. Unable to use 1.5, you rather have used two full years, or may have not used even 1 year fully, 0.5, or just may have used 1 year. Everything needs to be respected. The facts and figures have to be dead right. So 10,000 has to be the charge for each year. For 1.5 years, it will be 15,000 minus this. This should be the assets carrying amount, IM. When the loss of impairment that I have found turns out to be what? 15,000. Turns out to be 15,000. Turns out to be 15,000. Okay with that? Turns out to be 15,000. So after we are done with the figure work, you people have been able to revise once again the overall process of testing an asset for impairment. After that, no one will have an issue how to test an asset for impairment, as one more time in this question with proper computations, I have been able to give you the recap of. So impairment of an asset is a fall in the value of asset. You bring the value of an asset down. So to bring the value of an asset down, one thing is pretty much sure. I'll have to credit the asset account. Machine will be credited. An asset account will be credited. What will be debited? Profit and loss. So it is a loss that the profit and loss will take it. The profit and loss takes the debit of that impairment loss. The asset account correspondingly will be credited. I will exactly have to do the same up there for the property, but then one thing over there we have to respect. And the moment I will be able to start talking about, you will be able to connect. Once again, I'll have to credit the asset account. So I'll be able to credit the property account with the amount of 2 tetra 3. What do I have to debit? Usually it's the profit and loss that one has to take a debit of. But when an asset, the same asset in the past being valued, this asset was valued, and we have recorded a valuation gain on in OCI, later impairs, then the impairment loss will be charged to OCI in the first place to the maximum that it has a capacity to absorb, but that capacity is too big. We just need to take this much out of it, which is what we have. Imagine the loss of impairment if was 250,000. I would have charged 240,000 to OCI. Excess loss of 10,000 would have been taken to profit and loss. You definitely have seen me talking about these things back into the days when we were discussing the accounting for revaluation. Can you see the difference of two double entries? Asset is crediting, fine. But here we have come to debit the profit and loss, because this asset was never being valued previously, and you are going to record the loss for the very first time on, and that goes to profit and loss. But this asset was being valued previously, and gain of 240,000 was recognized in OCI. So in order to go and impair it today, I must have to make the use of this to the maximum extent, which I did. Good with that? No problem. And that's what's being written back into your summaries. They say that when an asset is a non-valued one, you go to debit the profit and loss with that loss and credit the asset. And when an asset is a revalued one, you still have to credit an asset account, but on the way it has to debit to OCI, excess loss will goes to profit and loss. To the extent that the valuation gain is recognized, excess loss goes to profit and loss. You're not watching this thing for the first time in your life. You definitely have done this discussion with me back in the days when we were discussing the accounting for revaluation in I-16. Good with that? No problem. Even you look back into lecture notes, from all the sides, I'm touching it. When an asset is being kept at historic cost, means at a non-revalued asset, takes the loss to profit and loss and credit the asset. But when an asset is being a valued one, you will have to debit the OCI to the extent that it has a surplus in it. Excess loss goes to profit and loss, while the asset will still have to be credited. In which function of cost the impairment loss is recognized? I will say to you, admin expense. Impairment loss is charged to statement of profit and loss, being the part of operating expense, and that I also can tell you it's going to be charged to admin cost. Good with that? It says when an asset is impaired, subsequent depreciation is based on impaired value. The value of an asset after impairment is called as impaired value. So if I have to depreciate that asset now, I will have to depreciate the impaired value of an asset for all those years to come. If I come to apply this thing to this question that we have done, learning example 7.3, the impairment was performed on 31st of December 8. Fine. So I'm getting into 2009 year and going to work the depreciations for both. Depreciations. For property and for the machine. So I'm into a year next to the year of impairment. The impaired value of the property, if I can remember, was 550,000. The impaired value was 550. After impairment, the value of the property turned out to be 550,000. The impaired value of machinery was 85,000. No, not 85,000, 70,000. Check this out. The value of the machine after impairment turned out to be 70,000. And then I have to go and take the remaining life, standing it onto that day. What has been the remaining life? See, on the date of valuation, 5 years were gone. On the date of revaluation, the 5 years were gone. How many years further gone till the date of impairment review? 2. It means total expired life is 7. Minus the 50 equals to what? 43. This is the life that's been left to use in the year of 2009 to depreciate. Applicable to this one, total life was 10, expired life is 1.5. So the remaining has to be what? 8.5. This is what I am preparing you for, everything, that you're not just done with the impairment review, but you are also getting to know what's going to happen in future, how many of those years we will be using it to depreciate for all those years to come. Every point has been ticked. Every point has been ticked. So after impairment, the depreciation is based upon impaired value and remaining life. That's impaired value, that's remaining life. Check this out. Impaired value, after you have recorded this much of impairment, this takes the value down to 550,000. How did I get 7 years expired? Till valuation, the 5 years were gone. Further 2 years are gone till impairment review. So total 7 gone out of 50, remaining has to be 43 or 45 minus 2 equals to 43. For this one, 1.5 years were gone, remaining has to be 8.5. This is something that even after explaining to students many times, still I've seen the students in the past, they take it casually and make blunders onto it. See, even back into lecture notes, they say the subsequent impaired value you have to use, less the scrap value, if any, divided by remaining useful. But that's what I have done. Learning example 7.4. Calculate the depreciation chart for the year ended 31st of December 9 for both the assets in learning example 7.3, assuming the Warner has estimated the scrap value of both the assets to be nil. In fact, this question, we have done it. But this is the question I was trying to answer. They want us to calculate the charge of the depreciation for both the assets for this year, assuming they do not have any scrap value. So I can mark that as learning example 7.4. 4. Good with this? Learning example 7.4. Good. But this is where we are done with the half of the topic. This is where we are done with the half of the topic. This topic was started almost 1.5 hours ago. We were at nowhere to understand what this topic is all about. Now people have started becoming good at what is impairment review, how to perform, what are the contents of it, what is recoverable amount, what is fair value cost to sell, what is value in use, how to test an asset for impairment, what are the factors internal to, what are the factors external to. Do I have to test it annually or do I have to test it on need basis? Lot of things the past 1.5 hours or so you've been able to look into and learn the topic of impairment. We are heading towards to the talk of very interesting reversal of impairment loss. You must have been wondering that we've learned impairment review. Now we're going to learn the reversal of impairment. What is it? Because we should have not rather impaired it if we are reversing it now. Or is it like an opposite of what we have done? And if it is opposite, then why have we impaired it in the first place? What is this? So let's go to understand the reversal of impairment loss. This only can be understood by the example that I'm going to put forward. Let's suppose the cost of an asset is 10,000 and the useful life is 10 years. The cost of asset is 10,000. The useful life is 10 years. After 2 years of the carrying amount of the asset will have to be 8,000. The carrying amount of an asset has to be 8,000, while the recoverable amount can be assumed as 5,000. This will require us to review this asset for impairment, and a result of that, an impairment loss of 3,000 has been found. Impairment loss of 3,000 has been found. Impairment loss of 3,000 has been found. Good. So in order to make the reversal of impairment, we must have to impair an asset first. So deliberately, I have come to impair it first, which now I expect to make the reversal of that in that coming year. After 2 years, or I would say after further 2 years, or you simply can write after 4 years. Further 2 years means after 4 years. What will be the assets carrying amount? What will be the assets carrying amount? See, after impairment, the depreciation has to be charged based on to the impaired value of an asset and remaining life. So that is telling the impaired value was 5,000. Remaining life 10 minus 2 equals to 8 years. So the carrying amount standing it today must have been what? 5,000 divided by 8 years remaining life multiplied by 2 years of further expired life. So this is going to give us the carrying amount of the asset after further 2 years, or effectively after 4 years. The figure turns out to be 3,750. The figure turns out to be 3,750. Okay with that? See, after impairment, the impaired value of an asset was 5,000. While standing it onto that, the remaining life was 8. Since 10 minus 2 equals to 8, so when I come to calculate the carrying amount of an asset after further 2 years, or effective, that thing has been used for further 2 years, minus this equals to this. Now, standing it onto that date, the recoverable amount has been found out to be by 9,000. So instead, this time the carrying amount of an asset is more than 2, turns out to be a figure less than 2. Turns out to be a figure less than 2. So this might take us towards a reversal of impairment loss, because impairment loss is there when the carrying amount exceeds over to a recoverable amount. This is the opposite of that. So I might be having a chance of reversing the loss of impairment, because previously the impairment loss was charged, which now we will get the chance to make a reversal of it. So how to make the reversal? This is where you will have to think in this manner. Listen to it. Making a reversal of impairment loss is not just like comparing this amount with this and making the reversal of by taking the figure in between 3750. It's not 3750 minus 9000 is a reversal. No, that is not the way this reversal will be found. It's about being a little more reasonable, because reversing the loss of impairment is not just like a valuation gain or loss topic that any amount that you are given, you will compare it with and you will be like, that's reversed. No, you will rather have to be a bit more fair or reasonable. You will have to ask the question this way to yourself. I'm standing after 4 years. So I have to ask my question to myself that, okay, what would be the assets carrying amount today if previously if it was never impaired? This way we have to think. I'm repeating, what would be the assets carrying amount today? Today means I'm currently standing it after 4 years. So what would be the assets carrying amount after 4 years? If previously, if it has not been impaired. Actually, previously it has been impaired on the way. But if that thing never happened, what would be the assets carrying amount after effective 4 years? It would have been 6,000. As after 2 years, the carrying amount was 8,000. So after 6 years, it would be 6,000. So that is the only balance I can achieve now. The figure that is in between now is the reversal of impairment loss, not in between these two. So this would be the assets carrying amount after 4 years. Carrying amount if an asset was not impaired previously. Carrying amount today must have been 6,000. This would be the assets carrying amount today if an asset previously has never been impaired. So to make the reversal of impairment loss, I have to do this. What has been the difference that you are finding it in? That should be 2250, I guess. Yeah, 2250. This is the figure of the reversal of loss of impairment. That's the reversal of impairment loss. That is the reversal of impairment loss. You have to think this way and be reasonable about that. Okay, I can only achieve that much which would have been there if an asset previously has not been impaired. So you only can lift your asset up to this at maximum, not to this. It's not like a valuation gain loss topic that you just can go to lift it up to any limit or lift it down to any limit. This has to be this way. Talk to yourself, okay, after 4 years, if an asset was previously never been impaired, what would be the assets carrying amount? The answer is 6,000. So yes, so reverse the loss of impairment up to that extent maximum. Good. So the double entry that will be passed for that will be the exact opposite of impairment loss double entry. Profit and loss will be credited now. Asset account will be debited. That is exactly the reversal of impairment loss. Profit and loss will be credited. Asset account will be debited by the effect of 2250. With that, asset account debit, profit and loss will be or have been credited. Something that needs to be understood. Check this timeline out. It's not getting finished. This is the timeline at which the carrying amount of an asset is 3750. The carrying amount of an asset is 3750. And this is what they have given to us is 9,000. This 9,000. So I have been able to make the reversal of this impairment loss down to 6,000. This figure in between is what we are calling it as. This figure in between, we are calling it as reversal. And the effect of that is 2250. And that is getting into profit and loss. What is the extra increase that we can see in it? What is that extra increase in it? The extra increase that we are finding it is in fact the figure of valuation gain. The figure of valuation gain. The extra 3,000 increase that we have found is the figure of valuation gain, and this goes to OCI. Now you get it? So first of all, you will have to take this amount up to 6,000 to make the reversal of impairment loss. And once it has reached up to that mark, extra increase that you have found into it is in fact the valuation gain, which goes to OCI. Good with that? This is what the way you have to understand this. So take your asset up to 9,000, but part of the increase is the reversal of impairment loss. The extra increase is the valuation gain. Reversal will be recognized into profit and loss. Extra gain will be recognized into OCI as valuation gains are recorded. And now you can come to complete the double entry to form the one. Asset collectively will take the debit of, there will be two credits. Profit and loss will take a credit. OCI will be credited by their respective amounts, 2250. An asset will take the debit by the combined effect of 5250. Okay with that? So asset by anyhow has been taken from this to that. Part of the increase is the reversal. Extra increase is the valuation. This to find, you have to ask this question to yourself. Okay, how should be the assets carrying amount after 4 years if this asset was never in the past been impaired? So the answer should be 6,000, and based on to that, you'll be able to find the reversal effect. You also will be able to find an valuation gain effect over and above 2. Reversal of impairment loss is allowed on every asset except one, goodwill. The one that we've talked about, the purchase goodwill, not allowed. So reversal of impairment loss is allowed on all the assets except goodwill. Looking back onto the lecture notes or summaries to see, the topic of reversal says the same. Reversal of impairment loss can be done for all the assets except goodwill. Impairment loss can be reversed up to the extent the carrying amount should have been there if an asset in the past was not impaired. Well, the accounting thing, I already have explained it to you. Income statement will have to credit. Asset account one has to debit to make a reversal of. And that is how the way you will have to deal it with when you have part of the increase is a reversal of impairment loss. The other increase is going to be the gain of valuation. So this side of the topic has also been covered. And in a more nice manner, when I construct an example on, it becomes more friendlier for you to understand the whole science. If anyone has got an issue, can write me into a chat box if something is not been understood in. I started off impairing it first, and then I came down to make the reversal of that. You people initially may have thought of that taking this value up to this is the reversal, but I have been able to put a little bit of a restriction into it. A restriction was that you only can make the reversal of the loss of impairment up to the extent to achieve this value that would have been there in the books today if an asset in the past was not impaired. That figure is the real reversal of impairment loss. Once this figure has been achieved, extra increase that you have seen into it is in fact the valuation gain. On this timeline, I have been able to explain this to all of you in a very such a nice way. Part of the increase is the reversal, excess is the valuation gain, and then the double entry to cater the both one in. Okay with it? Good going. So we are taking ourselves to practice few questions on impairment because this part of the topic we will keep it for our next course. It cannot be finished in next 30 minutes. So better rather to finish it in 30 next minutes and drag the remaining part of that into the next course. We can keep that to our next course. And the part of the topic that we have finished, we can practice some questions on, objective test questions from. It will be good for the health of good that this part of the topic we have finished, which in fact is a major part of the topic that we have finished. So we can practice few questions on before we leave the course. We'll have the better idea of how the exam questions of impairment are going to be like. This one. 39. Complete the statements using the options provided. The recoverable amount of an asset is the higher of two things. Is this the kind of a question that you will find it hard to answer? It's going to be fair value less cost to sell, and it's going to be value in use. Let's take the question number 40, which will enable all of us to understand the computations. This has been found onto page number 15. So L company owns a machine that has a carrying amount of 85,000. Carrying amount. The market value is 78,000. The cost of the disposals are 2,500. And a new machine would cost them around 150,000. L company expects it to produce a net cash flow of 30,000 per annum for the next 5 years. Now, this is the first question in which you will come to revise the discounting technique, or you probably will come to understand for the very first time. So let's redo the way that we test an asset for impairment. Remember this approach of preparing pyramids type. There we have the carrying amount. There we have a recoverable amount. Well, the recoverable amount is the higher of two things. The carrying amount is given. I guess it was given, the carrying amount. Yeah, the carrying amount is given, 85,000. The value in use and net selling price is something that we have to work. We have to rather look for. The market value is going to be the asset's fair value, and the cost to sales are 24,500. So it's 78,000. And 2,500, the figure turns out to be 75500. Our new machine would cost them around 150,000. Irrelevant. L company expects it to produce a net cash flow of 30,000 per annum for the next 3 years. There are 3 years. So let me write this whole thing in this manner. So I have been able to write the cash flows. In the second column, I will write the discount factor, and in the third column, I'll be writing those present values. How to find? Now, by the way, if the same question involves the scrap value, I would have topped up the scrap value of an asset into the last cash flow, which is not given, but at least I have been able to mention it, that if the question provides us with the scrap value, it would have been topped up into the last cash flow, because the scrap value of an asset is the ending value of an asset. It should go to top up into the last cash flow of the asset. The question provides us with the discount cap rate is 8%. So if I have to find the discount factor for the first year, how will it be done? 1.08 because of 8%. If it was 9%, it would have been 1.09. If it was 10%, it would have been 1.10. If the rate of interest is 15%, it would have been 1.15. Because I'm finding it that for the first year, so I will have to go this way. Or alternatively, it can be this way. If you have to find that out for second year, just need to change this to 2. Third year, just need to change this to 3. So it's going to be 0.926. Round this off to 3 decimal spot. 0.857. 3 decimal spot. 0.794. Yeah. Okay, so 0.926 multiplied by 30,000, 27780. 0.857 multiplied by 30,000, it's 25710. It's 0.794. It's by 23820. Now, this is the total that I have ended up working. Round it off. I found this figure to be the highest one, which is what I will be able to write it up there, 77310. So by how far the carrying amount exceeds over to a recoverable amount, that is called as impairment loss. But that figure is 7690. Which is the one we have to write it into it, 7690. The computations have not been the problem. This should be the answer. I can double check for just the peace of mind. It's 0.926. It's 0.857. It's 0.794. The 0.794 multiplied by 30,000, it's good, 23820. But that is the way the whole answer has to be. And that's how the way the questions of impairment are going to be like. This piece of information was totally irrelevant. Cash flows were given, and I have been able to discount them off. Fair value less cost to sell was easily worked. Carrying amount was already given. The way to answer this remains to be the same as I have explained this to all of you, the topic of impairment. Which two of the following would be the external indicators? Didn't I tell you the questions will even be like this? For 2 marks. And now you have to rather use the sense of, okay, how can a factor be set as external or internal? Any unusually significant fall in the market, no, market value fall is definitely the one we will have to select. That one word is enough. Market value of an asset. Evidence of obsolescence, no, obsolescence or physical damage to an asset is the same thing, which is an internal problem. A decline in economic performance of one or more asset. Performance is internal issue. Increase in market interest rates. Yeah. Market determines the interest rate. So market rates when gone up and gone down, this will affect the discounting of cash flows. So this is going to be the second factor to choose. That how simple is it? You just have to pay attention to one or two words, which will give you enough of a clue for you to say that, yeah, that is an external problem. That is an internal problem. This performance is internal. Obsolescence is internal. Could have not been selected. Market value decline is a market issue. Change in the rate of market is a market issue. The following info relates to the item of plant owned by Bazaar Company. So let's go on to this question the way as we even have done this one. It's to me like a simple question. Another one coming to our way. Which question is it? It's the question number 42 and on the page number 16. Question 42. Page 16. Let me rub off all of those figures to try and get. Okay. Its carrying amount in the statement of financial position is $3 million. The present value of the estimated cash flows from the continued use of the plant is 2.6 million. Present value of the estimated cash flows from the continued use. This is value in use because this present value of cash flow is value in use. The estimated cost of shipping the plant to Japan is 50,000. Now, shipping cost is a selling expense. Upon sale of that, you will transport it to Japan, ship to Japan. So here you are selling, and this is an offer that you have received from Japan in order to sell. So that should be the fair value less cost to sell, 2.65. 2.7 million minus 0.5 million. So selection is based upon by picking the highest. And here, the loss of impairment that we have found turns out to be $0.35 million. That's how the way the questions are going to be like. You have a knowledge, you will be able to work them out. And like I said, I always in the end, that number of questions I will keep on practicing. Fine. But if I will keep on practicing, you will be developing this impression that it's easy or I'm done with, I've understood. But that confidence thing, that confidence, that your body getting used to of facing such questions and practicing and answering and right answering, that if you are not going to adapt it, or you will not pass yourself through to that experience of attempting questions, making mistakes, refining those mistakes, and then time management by repeating those questions number of times, on the day of exam, very difficult the life of yours will become to deal it with all. Another question on the top of the page, number 44. Question 44. And that one is on page number 17. The net assets of, no, this one. What would be charged to statement of profit loss for impairment if this asset for the year ended September 4? So the year ends on September 14. The year will be starting on 1st of October 2013. Which company acquired a non-current asset on 1st of October 9? at a cost of 100,000, which had a useful life of 10 years and nil scrap value. Okay, so cost given, life given, and scrap value says nothing. The asset had been correctly depreciated up to that mark of 2014 September. So how many of those years have passed by? 2009 to 2014, 10, 11, 12, 13, 14, 5 years have been passed by. At the date an asset was damaged and impairment review was performed. Now, damage to an asset is a internal problem. This now will give us a push to go and check if an asset is impaired or not. The value of an asset, fair value of an asset was 30,000. And expected future cash flows are this much. The current cost of capital is 10% and 5-year annuity is this. Oh, why is this annuity provided? What's the whole use of that? You will get to know that in a while. So I will have to reload by applying that technique of solving the question one more time. The first thing first, the carrying amount needs to be worked. Yeah. So cost given 100,000, the life given 10 years, scrap value is nothing. 100,000 divided by 10-year life. Five years have gone by, minus 100,000. A figure will be 50,000. While they've provided to all of us with the fair value less cost to sell 30,000, so it's given, so we have taken. Value in use needs to be worked. They say that each year they will be getting, they will be paying, getting 8,500 for the 5 next years. So I can still go this way of finding my answer. We'll write the cash flows for 5 odd times, discount factor, and get this. But when the question provides us with annuity factor, this is like the shortcut to discounting technique. This annuity thing can only be applied once, in only one situation, when the cash flows are constant, which in this case are 8,500 per annum, means 8,500, 8,500, 8,500. They are not varying. They are not different from one year to next. Secondly, they are for the limited period of time, finite number of years, like 5 years. They're not for infinite number of years. In that case, we come to apply perpetuity. So these things you tend to learn more in your financial management courses. A little bit of that in this course will be asked to apply. So when they have provided to all of us with annuity factor, this will be worked to make the life of ours more easier. I would say quicker. Easy thing is this one also. I mean, what's so difficult to discount a cash flow? But if you go this way, it takes a lot of time. You come to write 5 cash flows firstly, then you write next to that the discount factor, and then each value is found. To find the total, it takes a longer route to reach to the same destination, which the annuity factor can take you to in few seconds. How? This way. 3.79 is the annuity multiplied by the cash flow. We will be able to get this answer directly in no time. 3.79, 8,500, the figure turns out to be 32215. 32215. Okay with that? No problem. Oh, I was supposed to work this answer somewhere else. It has been worked on wrong page. Yeah, this was the page of explanation. Here. Selection is based upon by picking the highest, and then we will have to see by how far an asset is impaired. It's going to be 50,000 minus this. It's 17785. That should be the figure of impairment loss. And we are going to select it, this one. Have you seen the way the questions of impairment they are testing you? Every question typically takes you down to through this process of working the recoverable amount in the first place, and then working the carrying amount, and go and check it by how far the carrying amount is in excess over to that excess is called as impairment loss. It's a third question we have done of the same kind. This one, first one, second one, and third one. Let's do one last effort. I'm leaving some questions on the way because these questions are from the second part of the topic, which we have yet to cover. So these questions, we will be doing it into our next course when we will complete this other side of the topic in the next course. We can do this question at least as this takes the two of those standards together in IS 38 and IAS 36. Question number 36, that is on page number 14. Okay. What should be the carrying amount of the brand in the statement of financial position of Sandown Company at September 9, 2000? So the first thing that I come to notice is the end of the year. If it ends on September 9, must be starting on October 2008. If it ends on September 30th, must be starting on 1st of October 2008. Yeah. So at September 2009, Sandown Company's trial balance showed a brand at a cost of $30 million. Less amortization being brought forward on 1st of October 8. So this is the amortization's opening balance. Exactly the day our year starts. So I can find the assets carrying amount on that day to be by 21 million. How have I got it? Cost minus this equals to 21. This should be the assets carrying amount to start the year with. Good. Amortization is based on 10-year life. An impairment review at 1st of April 2009. This is the day the impairment review is performed, 1st of April 2009. So this is happening somewhere during the year. How many months after the impairment review is performed? Impairment review is performed during that day. So it should be October, November, December, Jan, Feb, March. 6 months. 6 months after. Okay, so standing it onto that day, we must have to once again work the two items. The carrying amount and a recoverable amount. Net sale price and value in use. Okay, for this, they say that the value in use is given as $12 million. It's given, so whatever is given, we can keep on copying and pasting. While, however, on the same day, Sandown Company received an offer to purchase the brand for 15 million. So if someone is putting an offer to purchase my brand for 15, it must have been the sale value of my brand, which is this. Selection is based upon by picking the highest of two. That should be the assets recoverable amount. What will be the assets carrying amount standing it onto this date? Well, this will require us to make the use of the life of an asset and amortize for further 6 months. So if the cost of the brand is 30 and the life of the brand is 10, we need to find the answer for 6 odd months. So that figure has to be by 1.5. This will be the figure of the assets amortization. So if I go and take this 1.5 out of this 21, the carrying amount of the brand standing it onto that day turns out to be 19.5 million. 21 minus 1.5. 21 minus 1.5. Yeah. So what is the loss of impairment that you can see in it is 94.5. But they do not want me to impair an asset. They rather want me to calculate the asset's carrying amount, standing it onto the date of reporting. But on the way, we have been able to find the loss of impairment. So this is the value at which an asset in the books was carried at. This is the value at which the asset in the books was carried at after valuation, or you not valuation, after impairment, or you can call this as impaired value. Moving forward, impaired value will be used and the remaining life to depreciate. So what will be the amortization effect into the last 6 months? Impaired value of an asset, remaining life of an asset, they have told us about, revised to 3 years. If the life was not revised, we would have used the same original remaining life. But because they say that the life has been revised down to 3, so we must have to bring that into our use. And then 6 by 12 effect. So it's 15 divided by 3 will give us the $5 effect. $5 divided by 12 multiplied by 6 will give us the 2.5 effect. This will be the amortization of the last 6 months. So if I go and take this out of this, the carrying amount of an asset will be about $12.5 million. This is how the way we've got this. And this is what this question demands us to answer, and we're pretty much done. Again, after ending this poll, I will say this to all of you that again, it's looking simple to you that I'm working it out in a smooth process. But a question of this kind is going to be a nightmare to you on the day of exam if you're not going to face them, do a hardships onto it in the current life that you're living in. And you know that. But after even knowing that, we are lazy to it. Our attitude is lazy towards our studies. And this is something one has to accept. No one likes to study, but everyone wants to be a highly qualified finance professional, but no one wants to give any hours of hardships in the current life we are living in. It's a harsh reality. We know that ultimately what this qualification can give us to in the future. And we have lots of examples around you. The companies that you work in, your colleagues, the senior colleagues, or all the people in the finance profession that you know around, you know them once they had been like the students of you, but with the qualification that they have got, with the experience that they have got, they are at the level that you want them to be. You want you to be. But we do not want to give any hours of studies, and you could see a little bit of a time up hours in practicing these questions, in revising. 5 reporting standards being finished. 6th one, half finished. And see the amount of questions I have been able to practice. After that, is there any excuse left that you have it and you have to make it that will stop you doing some questions at your side? See how many questions have I practiced? This was the first one. Repeated in second time, the same thing. Third time, same thing. Fourth time, even better. And some questions which we have solved were itself on the face of the exam kit, like this one was solved itself on the face. This one was solved itself on the face of the exam. So about 6 questions on the part of the reporting standard we have finished, I have done. Another part is still to be finished, and I will come to complete the questions in regards to that. This way, since the start of the course, I have been conducting courses, giving my full of the time and the heart and my energy, like always the case. Not the first times you people are very special to me. not the others they were in the past. So I'm giving you a special attention to that. The others in the past have never enjoyed. It's been the case like for all the subjects that are lectured. May it be a financial reporting, taxation, SBR, advanced taxation. And every time I meet to the students, I say the same, that I'm even saying this to you. Wake up before it is too late. 5-6 sessions have gone by, and so far, even if you have not been able to think a lot much what's good bad for you, start thinking of the time is passing it on too quickly. Every time we meet up, the course goes by and then finishes off. See, it's the end of the lecture 6 today. Lecture 6 means people already have met me about 6 times in a space of past 1 month or so. How quickly that has flown away. Have you realized? Time will never stop for anyone. Victory to those they will be with the time, not will lag behind. This way, every time I will come to meet you 7th lesson, 8th session, lecture 9, lecture 10, and ultimately you will not realize the day the course will end and you will be in the month of November. It looks so far, but we're about to enter into a month of September. It's passing on too quickly, and you have had a good relaxation time. The month of June after exams, you were not taking the courses. July, the courses were started in the middle of the month of July. So you have had enough time after last time you have attempted the exams, and you should start getting back into that mode of studying once again. A little, which when you will start gradually, you will start increasing the efforts of yours, the time spending, but a little at least can start. The little is what that you revise the whole course that I gave it to each you time, and then do some practice questions onto it from the Kaplan exam kit, from the BPP exam kit, just to gain the confidence that I'm well with the class, practicing also, revising it also, and over the life, this will make me feel better as I'm connected. And then in the month of November, all of that thing will come back to my way to revise. And I'll be confident on the day of exam going, and eventually, hopefully, will be passing also. Pretty much the ends of the course of today. A topic of impairment is in the full flow. I'm leaving you with the course at. The next time we will meet up, exactly we will start it off the point that we have left the standard at. Come up with whatever we have done today so that you will be in the same flow that you are in right now while you come to see me 6 days after into the next session. That concludes the course of today. I will see you in the next course to continue. Have a good time and have a good weekend. Thank you very much.